In our last class, we started sensitivity analysis, and of course, we were discussing the concepts before the network issue came up, and we were unable to continue the class. So today, I will just do a recap on what we did last time on sensitivity analysis. We said that sensitivity analysis represents the tolerable extent to which a project NPV can accommodate any change in variables. All right? It measures how sensitive a project NPV is to variables that make up the project being evaluated. All right? So that is sensitivity analysis. Okay? For this purpose, we said variables include initial outlay, variable cost, attributable, specific, or incremental fixed cost, sales volume, sales value, scrap value, savings, contribution, cost of capital, project life. Any component of the project, any element that make up the project are being evaluated are called variable. All right. So those we want to know sensitivity analysis measure how sensitive is the project NPV to each of the variables. You want to know what if your initial outlay increased by a specific percentage? Can the project still be viable, right? If the sales volume, for example, reduced by 5%, can the NPV still be positive? All right, so this is what sensitivity analysis measure. And then we proceeded to talk about how to calculate sensitivity margin of variables. I gave you three different formulas that you can use depending on the variable. For all the variables, excluding cost of capital and then project life, sensitivity margin will be computed as NPV divided by present value of variable. All right. Then to calculate sensitivity margin of cost of capital, it will be internal rate of return minus cost of capital over cost of capital. And the last one is sensitivity margin of project life or product life, depending on what examiner uses. So to calculate sensitivity margin of project life, it will be project life minus break-even point of project life over project life. So what that simply means is that you need to first of all go ahead and calculate break-even point of project life before you can proceed to calculating the sensitivity margin of project life. So to calculate the break-even point of project life, there are two different methods that you can use. Number one is to follow this procedure, follow these steps. The second one is to just go ahead and calculate discounted payback period. So whatever you have, using discounted payback period, we give you the sensitivity, we give you the break-even point of project life. However, using these procedures, the first step is to reduce the life of the project by 1. All right. Let's say, for example, if the useful life of the project is 5 years, 5 minus 1 remain 4. You then calculate NPV for 4 years. All right. Then step 3, which is the final step, is to calculate the break-even point of project life using the formula of internal rate of return, right? So using this formula, we said that ROL represents reduced life, NL represents normal life. So once this is done, of course, whatever you have thereafter will then be the break-even point of project life. Once you have that, then proceed with your calculation of your sensitivity margin of project life. Then finally, I also mentioned to you that anytime you are computing sensitivity margin or whenever examiner asks you to calculate sensitivity margin of sales volume, you are expected to use the present value of contribution as the denominator, okay? You are supposed to use the present value of contribution as the denominator. All right. Finally, anytime you compute sensitivity margin of variable, you are required to interpret your result. At times, examiner will not tell you, but it is your responsibility. It is for you to be able to earn your full mark because your answer will be meaningless. All right. Your calculation will not make any sense if you do not interpret your result. So, and this is what I was trying to explain last time before I was shut out by network. But that notwithstanding, so we continue from where I stopped last time. Okay. Now, like I said, for all variables, for variables such as sales value, sales volume, scrap value, all right, savings, okay, savings, project life or project life, then your interpretation should be that the variable should not fall or decline, should not fall below the percentage attained. Otherwise, the project will not be viable. The project will not be viable or the project will not be accepted. So that's what you need to do.
Mr. Adejole, ti ń pẹ́.
Tosin, please mute. The second interpretation is for variables such as initial outlay, variable costs, incremental, attributable, or specific fixed cost, cost of capital or cost of capital. Then when you have this kind of variable, when you have any of these variable, your interpretation should be that the variable should not increase beyond the percentage attained. Otherwise, or if not, the projects will become unviable or the project will not be accepted. So this is the way, and this is how to interpret your result anytime you compute sensitivity margin of variable. So at this point, let's have illustration to demonstrate this. Okay. Yes. Which one is this one? Okay, I think. Yes, this is it. So illustration number 3. Somebody was making noise at the background the other time. Yes, I think it's Tosin. Tosin, will you read for us? That's the price for making noise in the class.
I'm sorry, I don't know.
Tosin, read.
Sir, good evening, sir. Good evening, everyone. Tinapa PLC has sought your advice as a financial consultant on its investment
Good evening.
proposal.
How are you today? Yeah.
It plans to diversify into the production of toilet soap. You are provided the following information relating to the proposal. The initial investment in plant and equipment will cost 4.8 million naira. The plants are expected to have a lifespan of 10 years with negligible scrap value. The company plans to maintain a minimum of 80% of installed capacity each year. At this activity level, 240,000 units are expected to be produced. The annual production overhead, excluding the depreciation, is estimated at 360,000 naira, while variable cost is planned at 18 naira per unit. The market research carried out favors setting the selling price at 24 naira per unit. The company's cost of capital is 17%. You are required to advise whether the investment proposal is worthwhile, calculate the tolerable level at which the following can vary without any adverse effect on the investment proposal. 1. Initial investment cost, production cost, sales price, sales volume, variable cost, product life, and cost of capital. Annuity formula is given as this.
All right. It's okay. All right. Thank you, Tosin. Yes, that is the question. See, anytime you are given a question and you are asked to determine sensitivity margin of variance, you can see in this question, number A is very straightforward, right? You have to advise whether the investment proposal is worthwhile, meaning that you are supposed to calculate the net present value. But in this number B, examiner mentioned that you should determine the
Thank you.
tolerable level at which the following can vary without any adverse effect on the investment proposal. Of course, you need nobody to tell you in this requirement number B that you are supposed to calculate sensitivity margin of variable, because examiner has mentioned tolerable level, and you know that sensitivity analysis measures the tolerable extent to which a project NPV can vary, all right, uh, or can accommodate any change in variable. It measures how sensitive is a project NPV to variables that make up the project being evaluated. This is sensitivity analysis. So we have about 7 variables in this particular requirement, and let's stop sharing this and move to the working notes within the next few minutes. Let's finish up and move to the next one. Okay. Solution to illustration. What number is that? That's an illustration number 3, page 63. Okay. So the name of the company is Tinapa Limited. So number A requirements, we are to calculate NPV. Calculating net present value. Let's restrict our numbers to thousands. Because we do not have multiple variables, so no need to use columnar formats. We then create a column for year, description of items, cash flow, discount factor, we are told discount factor is 17%. Then we have the present value. Year 0. The useful life of the project is 10 years. So year 0, we have initial investments. Initial investment is 4.8 million naira. So our numbers are in thousands. So multiply by discount factor of 1, we have 4,800. Then in the question, you are not given cash inflow, but the examiner has given us selling price and variable cost. So according to the question, we are given selling price of 24 naira, then variable cost of 18 naira. That means contribution per unit is 6 naira. So let's go and calculate contribution. Without going too far, let's put our work in here. Don't do this on the day of your exam. Your working should come last. I don't want to be flipping pages. That's why I have to go to the second page. So contribution. And you know that contribution equal to selling price minus variable cost per unit. So we are given selling price of 24 naira, variable cost of 18 naira. So contribution per unit is 6 naira. We then determine total contribution. Total contribution will then be equal to the number of units. We are told that 240,000 units will be produced. So 240,000 units. So it means that the units produced is the same thing as units sold multiplied by a contribution of 6 naira. When you multiply, this is 240,000. So 240,000 multiplied by 6. This should give you 1,440,000. All right. So I will then go up there. Our annual contribution is 1,440,000. Our figures are in thousands. So from year 1 to year 10 is the same amount of 1,440. Therefore, we need to go and calculate annuity factor of year 1 to 10 at 17%. Annuity factor of year 1 to 10 at 17%. So this would be 1.17 raised to power 10 minus equal, okay, minus 1 equal divided by 0.17 equal to 4.659. This is 4.659. Then in the question, we also have production cost, excluding depreciation, 360,000. So here is production cost, 360,000. Year 1 to 10. Well, is it every Tuesday I'll be experiencing this? I beg go. Let me reshare. Why always Tuesday I'll be having network glitches? Okay, let's continue. So here is 4.659. There's no scrap value in the question, so no need to worry ourselves. We don't need to multiply. That would be 4.659 multiplied by 1440. That is 6709.
6709.
Yeah, 6709. 6709. Then the second one for production cost.
1677.
1677. So what's our final answer? NPV. So NPV will then be equal to 232,000. Okay. So now that the examiner is asking us in the A requirement that we should advise whether the investment proposal is worthwhile. So since our NPV is positive, we then advise that the investment proposal is worthwhile considering the positive net present value of 232.
Voila.
Hopefully, we are going to have a complete class tonight. So the NPV list, the project, the investment proposal is financially viable, considering the positive NPV of 232,000 naira. We then move to B part. The B part of the question, you are to ascertain the tolerable level to which the project NPV can vary. All right, so I can then say sensitivity, calculating sensitivity margin, SM of variables. So according to the question, the first variable given to us is initial investments. So I would then say sensitivity margin of initial investments, which is calculated as net present value over the present value of initial investments multiplied by 100%. So NPV is 232. PV of initial investments is 4,800. Multiplied by 100 over 1. So what do you have here, Tosin? 232 divided by 4,800. 232
4.833
divided by 48. That's 4.83%. All right, so 4.8%. So the interpretation of this is that the initial investment can still increase by 4.8%. Any further increments beyond this 4.8% will make the project to be negative. It will make the project NPV to be negative. So the tolerable extent to which the project NPV can accommodate any change in initial investment is 4.8%. So if you calculate now, if you recompute your NPV, you increase the initial investment by 4.8%. So you are supposed to get NPV of 0. This 4.8 will make your NPV to be equal to 0. Any further increase in initial investment beyond this 4.8 will make the project NPV to be negative. So you then come here, you interpret your result. The initial investment, so the initial investment should not increase beyond 4.8%. Otherwise, the project will not be viable. Otherwise, the investment proposal will not be viable. So that is how to interpret, how we are going to interpret the initial investment. Then move to the next variable. The second variable. The second variable is production cost. So you then say sensitivity margin of production cost, which is the same formula, NPV of 232 over the present value of production cost. Present value of production cost is 1677 multiplied by 100 over 1. Tosin, what do you have as your final answer? I'm not sure you are there. 232 divided
13.83.
by 1677.
13.83, sir.
13.83%. Here is 13.8%. So which means that the production cost should not increase beyond 13.8%. If not, the investment proposal will not be accepted. So again, our calculation shows that the company can still increase production costs of 360,000 naira. They can still increase it by 13.8%. Any further increments beyond the 13.8% will make the NPV to be negative. All right. Number 3, sensitivity margin of the next variable is sales price. Sensitivity margin of sales price, which is NPV of 232 over present value of sales price. I don't know the present value of sales price, so I need to go and calculate it. Okay. Let me use PV of sales price. This will be computed as the PV of sales price will be equal to, first thing first, before you can calculate PV of sales price, you need to determine the total sales. Total sales will be number of units sold, which is 240,000 units, multiplied by selling price of 24 naira. This will give us 5 million. Is it 5,760,000? Confirm for me, please. What do you have?
Yes, sir. 5,760.
Then PV of sales will then be equal to 5,760,000 multiplied by annuity factor of 4.659. So this will give us 26 million watts.
Twenty-six 835 840.
26
835
835
840.
840. So our numbers are in thousands. So here will be 26 836 multiplied by 100 over 1. What's the final answer?
Oh, okay. 232 divided by 1. 836.
So
Mm.
you appear to be distracted.
86%. 86.
You say it's what?
86%.
36.
8.
You're on your own. You're on your own.
6. 836. Oh, 8.6.
232 divided by
8.6.
you're on your own. 232 divided by 26 836 equal, then multiply by 100. That's 0.86. That's 9%. 0.9%. So you then interpret that the sales price should not fall below 0.9%. This means that we can still reduce the selling price by 0.9. Any further reduction will make selling price will make the project NPV to be negative. All right. Okay, then number 4. Sensitivity margin of which is number 4 of sales volume. Sensitivity margin of sales volume. So this is computed as NPV of 232 divided by PV of contribution 6709. Remember, when you are calculating sensitivity margin of sales volume, you have to use the PV of contribution as your denominator. So here multiplied by 100%. So what do we have here? 232 over 6709. That is 3.5%.
3.5%.
Okay, so here is 3.5. You then say the sales volume should not reduce below 3.5%. If not, the investment proposal will not be accepted. Number 5, sensitivity margin of variable cost, which is NPV of 232 over the PV of variable cost. We don't have the PV of variable cost. We need to go and estimate it. So PV of variable cost. First thing first, you must calculate the total variable cost, which is... Tosin, please mute yourself.
It's not me, sir.
Which is total variable cost of 240,000 units. Oh, okay, sorry about that. Then multiply by variable cost per unit of 18 naira. So this will give us 4 million, I think 320,000. Therefore, PV of variable cost will then be equal to 4,320,000 multiplied by annuity factor of 4.659. This will give us 20 million
4.126,880.
So 126
880.
what? 880. So that's the PV. Yes, that's the PV of variable cost. So I will then come here, 20,127. Our figures are in thousands. So 232, here will be 232 divided by 2127. That's, is it 2127? Yeah, let me see. Yes, 2127.
1.2%.
That's 1.2%. Here is 1.2%. You then advise that the variable cost should not increase above or beyond 1.2%. Otherwise, the project will not be viable. Number 6, let's move faster. So number 6 is sensitivity margin of products life. Sensitivity margin of product life which is computed as product life minus break-even point of product life over product life multiplied by 100 over 1. So in this case, we need to go and calculate. We already know product life to be 10 years. The useful life of the project is 10 years, but we don't have the break-even points of the product life. So we need to go and estimate it. So let's use this page. Calculating break-even points of product life. All right. So we said there are 3 steps to be carried out. Step 1 is to reduce the life of the project by 1. Step 2, calculate the NPV of the reduced life. Then step 3, calculate break-even point of product life using the appropriate formula. So the life of this project is 10 years. 10 minus 1 year, so that will give us 9. Then we need to calculate NPV for 9 years. So NPV of reduced life. So create a column for year, description of item, cash flow, discount factor at 17%. Somebody should give me annuity factor of year 1 to 9. Year 0, 1 to 9, 1 to 9. Initial investments, annual contribution, annual production cost. Here is 4,800, 1,440, 360. What do you have as annuity factor? Year 1 to 9 at 17%.
4.451.
451. So let's multiply to get the present value. What's the
6409.44.
6409.
09.44.
Okay. The second one, production cost.
1602.36.
102. Difference of 7. This is NPV of reduced life. So that's step 2. All right. Step 3 says we should then calculate the break-even point of product life. So break-even point of product life equal to reduced life plus net present value of reduced life over net present value of reduced life plus net present value of normal life multiplied by normal life minus reduced life equal to reduced life is 9 years. NPV of the 9 years is 7 over 7 plus NPV of normal life, 232. Then multiply by normal life of 10 years minus reduced life of 9 years. So this will give us 7 divided by 239 equal, multiply by 1 equal. What do we have? 9 point what? Okay. Let me use my calculator.
9.03.
9.03 years. So that's the break-even point of product life. I will then go back to my calculation. So here is 9.03 divided by 10 years multiplied by 100%. So this will give us 9.7%, which means that, let me give space. This is equal to 9.7%. So this means that the life of the project can still reduce. The useful life of this project can still reduce by 9.7%. Any further reduction will make the NPV to be negative. All right. The product life should not reduce below 9.7%. If not, the investment proposal will not be accepted, will not be accepted. The last one, number 7.
Sorry, sir. Hello, sir.
Who is speaking?
Of course, my name, sir.
Yeah, talk to me.
Thank you. I want to that how you got that 7.
Who is 7?
This is it not
Is the
7?
is the NPV now? That the 7 is NPV we computed.
Yeah.
That's the
No, okay.
NPV
Oh,
of
that
reduced
is true.
life.
It's okay. All right,
All
sir.
right. So the last one is sensitivity margin of cost of capital, which is computed as internal rate of return minus cost of capital over cost of capital multiplied by 100 over 1. So from this formula, since we have internal rate of return, it means we need to go and calculate internal rate of return. So I would then come here, calculating internal rate of return. And you know that to calculate internal rate of return, you are expected to assume 2 discount rates that will produce 2 opposing NPV, a positive and negative NPV. All right, we have calculated NPV before using 17% discount rates. We got 232 positive. So let's try 20%. If 20% is positive, is negative, then we assume 17% as the second discount rate. So you then say assume 20%. Let's use this 20% to calculate NPV. So here, item, cash flow, discount factor at 20%. PV, here 0, 1 to 10, 1 to 10. All right. Initial investment, contribution, production cost, 4,800, 1,440, 360,000. Somebody should give me an annuity factor of year 1 to 10 at 20%.
4.192.
Thank you. Here is 1, 4.192, 4.192. So give me the present value.
6036.
6036. Production costs,
1509.
1509. Final answer. That's two what?
273.
Yes.
273.
273 negative. So we assume
Negative.
20%, we got a negative NPV of 273. So that means we assume 17%. We also assume 20%. We then proceed to calculate internal rate of return, which is lower discount rate plus net present value of the lower over net present value of lower plus net present value of higher. Higher discount rates minus lower discount rates. A is 17%. NPV of 17% is 232 over 232 plus NPV of higher 273. Higher discount rate of 20 minus lower discount rate of 17. Final answer, what do you have here? 18 point what?
18.338.
38%. So we then go up there and complete our calculation. So internal rate of return is 18.38 minus cost of capital of 17% over cost of capital of 17 multiplied by 100%. Give it to me. What's the final answer?
8.1. 8.1%.
8.1%. So this means that the cost of capital should not increase. The cost of capital should not increase beyond 8.1%. If not, the project will not be financially viable. So that's that. That's end of sensitivity analysis. Like I mentioned last time, in recent time, what ICANN does is that it's been a while ICANN tested sensitivity analysis as a complete question. What they do in recent time is to just ask students to calculate sensitivity margin of one particular variable. It could be tax liability. Examiner can ask you to determine sensitivity margin of tax liability or sensitivity margin of scrap value or sensitivity margin of working capital. Whatever it is, it's still the same thing, the same formula you are going to use. So the most important thing is that you just have to understand the concept. So however examiner is coming out, you'll be able to tackle it headlong. All right. So that's that. So let's move to the next one. We are moving to simulation. Let's talk about simulation. All right. So you open to your material at your end. Let's follow through together. Simulation. Let me just give you a short note. Simulation. This involves the process of mimicking. This involves the process of mimicking a model in form of a real life situation. It is a method of mitigating risk and uncertainty that relies heavily on the random number, that relies heavily on the use of random number, random or tag number. Okay. It should be noted that the expected NPV computed using simulation method. Please mute yourself. Using simulation method will not produce optimal solution, but near optimal or good enough. Or good enough solution. This is because not all cash flows will be selected or well represented. So what we are saying is that when you want to calculate expected net present value using simulation method, you are selecting your numbers randomly. So you are not going to select all the cash flow of receipt and payment given to you. For this purpose, you cannot have optimal solution because you are picking numbers randomly. All right. So when you are calculating expected NPV, expected net present value, the most important thing to do is to simulate for each variable of receipts and payments, that is cash inflow and cash outflow, and then use the simulated results, to compute net present value. The result is known as expected NPV using simulation method. So that's all you need to do as far as simulation is concerned. However, let me give you a format to simulate. Okay. Simulating for variable. So anytime you want to simulate, this is the format that you can adopt depending on the variable you are calculating for. So the first item, the first column will be the variable you want to simulate for. The next column will be probability. Next one will then be cumulative. Cumulative probability in percentage. Then the next one will be random allocation. The random allocation is just like class interval. Then the random number or tag number that examiner will give to you. So let's say you have this probability, then your allocation. You put the random number into the appropriate cell. So this is the format to simulate for variables, either receipt or payments. All right. So this is how, like I said, when you are asked to calculate expected NPV using simulation method, the first thing you need to do is to simulate for each variable of receipt and payments using this format. Okay, you use this format to simulate for both receipt and payments. You then use your simulated result to go and compute net present value. All right, so that will give you the expected NPV depending on the set number given to you. If you are given 4 different sets, that means you are going to calculate 4 different NPV. If you are given 10 sets for both receipt and payments, then of course you are going to calculate 10 different NPV. At the end of the day, you find the average expected NPV. So that's all you need to do. So let's stop sharing this and move to the learning material to solve question. All right, let me see. So let's solve illustration number 6. Equity Pro Limited has prepared the following probability estimate for a proposed investment project. So you are given cash flow of receipts and payments, revenue and running costs with their associated probabilities. All right. Cost of capital is 12%. Required: A, calculate the net present value of the project. All right. B, analyze the risk inherent in this situation by simulating the NPV calculation. You should use the random number given at the end of the question to simulate 3 sets of cash flows. On the basis of your simulation results, what is the expected NPV? C, explain briefly why the NPV calculated in A and the one calculated in B may not necessarily be the same. So this is the random number given that examiner said we should find at the end of the question. All right. you should use the random number given at the end of the question to simulate. All right, so this is the question. The number A part, you are to calculate net present value. How do you calculate net present value in the A part? We can see from the table given to us, we have probability and cash flow. You should know that anytime you are given probability and cash flow together, you are supposed to calculate expected value. Therefore, in the A requirements, you are required to calculate expected net present value using the expected value method. Number B, you have to calculate expected NPV using simulation method. Then number C, examiner is now asking you to explain briefly why the expected NPV using expected value method in A is different from the expected NPV calculated in B using simulation. All right, so that is the question. Let me stop sharing and then move to the working notes quickly. Within the next, in fact, if you can finish this within the next 15 minutes, that would be good for us. So solution, so illustration, and that's illustration number 6 or thereabouts. Yes, illustration number 6, page 64. All right, the name of the company is Equity Pro Limited. Number A, we're asked to calculate expected NPV. So I would then say calculating expected net present value using expected value method. Okay. So create a column for year. Description of item, cash flow, discount factor, present value. According to the question, we are given cost of capital of 12%. Useful life is 5 years. So year 0, initial outlay. How much are we investing on this project? Initial outlay is 40,000 naira. Then year 1 to 5, revenue. We also have running costs. Year 1 to 5, running costs. So we need to go and determine, in the question, we don't have scrap value. So we need to go and determine our expected value, because in the question, you are given probability and cash flow together. It means that we need to go and calculate expected value. We then use the expected value computed to go and calculate our NPV. All right. So that will give us expected NPV using expected value method. Okay. So let's go and calculate. Let's do working. Hopefully this will be sufficient. Let me see. Let me create additional page. All right. Yeah. So for our working, we want to calculate expected value. Calculating expected revenue. Okay. To do this, we create a column for probability. Remember, we said that expected value, denoted as X bar, is computed as summation of probability of X. That is, you multiply probability with cash flow. Okay? So, to get our expected revenue, we create a column for probability. Then we have cash flow, which is revenue. Then we have expected revenue. Here is P, here is X. So this should be X bar. So I will then go back to the question, what is the probability of revenue? We have 0.15, 0.4, 0.15, 0.40, 0.30, 0.15. So at all time, your probability must be equal to 1. Here is 1. So expected revenue. So again, what is the revenue? 40, 50, 55. 40,000, 50,000, 55,000, 60,000. Okay. I will then multiply 0.15,
6,000.
6,000. Next, 20,000. Next,
16,500.
16,500. Next,
9,000.
add everything together. 26, 35, 25,
51,500.
51,500.
51,500. So this is expected revenue. All right. We then calculate expected running cost as well. Working number 2. Calculating expected running costs. So probability running costs, expected running costs. Then pick the probability of running costs, which is 0.4. Probability X X bar 0.4, 0.25, 0.35. When you add it up to give you 1. Then the running cost for each probability 25, 30, 35. 25, 30, 35. We then multiply. What do you have?
10,000.
10,000. Next,
7,500.
75. Next,
12,250.
12,250. This will give us 29,
750.
750. So we can then proceed. Since we have expected revenue and then expected running cost, we can then proceed to calculate our expected net present value. So here is 51,500. Here is 29,250. We then calculate annuity factor of
It's
year 1 to
750,
5.
sir.
750, thank you. So we need to calculate annuity factor of year 1 to 5 at 12%. So we don't have scrap value in the question. No worries. What's the annuity factor?
3.605.
3.605. What's the present value? Present value?
185,658.
185,
185,658.
658. Running cost?
107,248.
107,248.
You don't
What's the
want to put delay?
difference?
Okay.
Okay, 249.
So what's the difference?
$38,409.
38,409 positive. So that's our expected NPV. So in the A part of the question, you have to calculate the net present value of the project. That's what we have done. All right. Then number B, we also asked to calculate expected NPV using simulation method. So to do this, number B, calculating expected net present value using simulation method. So in this case, because you are using simulation, you are given 3 different sets. So you are going to pair revenue with running costs for each set. That means you are given 3 different sets. It means that you are going to calculate 3 different NPVs. But before you can proceed with this, you need to go and determine your simulation. So let's go and calculate simulation for each receipt and payment. Working number 3. So we need to simulating for revenue. Let's simulate for revenue. You create a column for revenue. Probability, cumulative probability in percentage. We have random allocation. We have random number. Okay. So call the revenue for me. Give me the
40,
revenue.
30. Is it from
40,000.
the Oh, okay, sorry.
50, 50,000,
Okay.
55,000, and 60,000.
55 and then 60,000. Give me the probability for revenue.
0.15,
Next.
0.40,
Next.
0.30,
And then
0.15.
0.15. So we need to find the cumulative of probability in percentage. The first probability is 15. So here will be 15. 15 plus 40 will give us 55. 55 plus 30 will give us 85. 85 plus 15 will give us 100. Next, we want to determine the random allocation. You have to start from 0, 0. So, like I said, your random allocation is just like class interval. So 1 minus 15 will give us 14. After 14 is 15. 1 minus 55 is 54. After 54 is 55. 1 minus 85 is 84. Then after 84 is 85 to 99. Your random allocation will start from is between 0 and 99. I will then go back to the question. For revenue, call the random number for me. What are the random number for revenue? Yes.
30,
Okay. The
30,
first one is 30.
20, 79.
So 30, you look for your random under your random allocation. Where does 30 lies? 30 will fall here. We also have 20. 20 will fall here. Then the last one is what?
79.
79 will fall in the third row. With this, we have simulated for revenue. You do the same thing for running costs. Simulating for running costs. Okay. There will be running costs. Probability. Cumulative. Probability in percentage. Random allocation. Random number given to us. So give me the running costs. Running cost
25,
is
30, 35,
25,000, 30,
30,000, 35,000,
35,000. Probability,
0.40,
uh-huh,
0.25, 0.35,
0.35. So here will be 40 plus 25, 65,
65,
plus 35, 100. So random allocation starting from 00 to 39.
30.
After 39 is 40 to 64, then 65 to 99. Then what are the tag number for a running cost? Random number for running cost, sorry, for running cost, yes.
71,
71 with 4 here.
00,
Next,
00,
00 is here. Next,
94,
94 is here. So again, with this, we have simulated for running costs. We then use our simulated results to go and compute for NPV for each set. We are given 3 different sets. It means we are going to calculate 3 different NPVs. So I will then say set 1. Here, item, cash flow, discount factor at 12%, present value, year 1 to 5, 1 to 5, initial outlay, revenue, running costs. Now pay attention here. Initial outlay is 40,000. Pay attention. Here is 40,000. Now for set 1, you go to your simulation. For set 1 in the question, what's the random number for set 1? Revenue. Random number is 30.
30.
So you then go to your simulation table. From your simulation table, where do you find 30? Please, that person should mute, please. So, random number for revenue is 30 for set 1, is 30. So 30 is in the second row. Therefore, you trace it to the left where you have the revenue, under revenue. So whatever cash flow you have there, you pick it. That's 50,000 naira. So I will then come here. Here will be 50,000. Again, for set 1, under running costs, random number is 71. Under running cost, simulation for running costs, 71 is in the third row. You trace it to the left. 35,000 naira is the cash flow. So here is 35. $3.605. 3.605. You then multiply to get the NPV. So here will be 3.605 multiply by 50,000. That's 182.50. 180,250. The next one is 35,000.
126, 175.
126.
175.
175. What's the final answer?
I'm coming. 14,075.
14,075. Expected MPV. For set 1, we then do for set 2. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. Okay, let's manage this. For set 2, do the same thing. Yeah, 0, 1 to 5, 1 to 5. Initial outlay, revenue, running costs. 40,000. 40,000.
Okay.
So
50,000.
for set 2,
It's
the
50,000.
the random number for set 2 is 20. Random number set 2, revenue is 20. So again, we go to where we have the simulation. Where do we indicate 20? 20 is on the second row, which is 50,000. All right. So here will be 50,000. Then for running cost, set 2, running cost, that's 0, 0. 0, 0, you trace it from your simulation for running cost. 0, 0 is on the first row, which is 25,000. Here will be 25,000 negative. 3.605. Here will be 180,250. So what do we have? Present value of running costs.
9125.
9125. Final answer.
5125.
5125. That's expected NPV for set 2. We then move to set 3. Yeah. Item cash flow. Discount factor at 12%. Present value 1 to 5, 1 to 5. Initial outlay, revenue, running costs 40,000 multiplied by 1, 40,000. Wow. Time is still flying. Then we go back to our simulation. From the table, give it to us in the question. Random number for revenue for set 3 is 79. 79 is a row 4, which is 60, row 3, which is 55,000 naira. Here is 55,000 multiplied by 3.605. Then for running costs, random number for running costs is 94 for set 3, which is 35,000 naira. Here is 35,000. So what do we have? What's our present value?
For revenue, 198,275.
198,275. We
For
have calculated 35 before.
yes, 126.
126,175. 126,175.
Final answer.
Final answer.
32,100.
32,100. So you can see that we have three different expected NPV. You need only one result, so we need to find the average. Average expected net present value would then be equal to the first expected NPV is 14,075 plus the second one, which is 5125. And for third set, 32,100. Because you added three different figures together, then you divide by 3. Give me the final answer. What do we have here? What do we have?
32,100.
32,100. You can then say the expected net present value using simulation method is 32,100. The number C requirement of the question. Examiner is asking that we should explain briefly why the NPV calculated in A is different from the NPV calculated in B. All right. So in A parts, we calculated expected NPV of 38,409 naira. In B, we calculated expected NPV using simulation and we got 32,100. Why are they not the same? Because it's the same expected NPV, but why are the figures different? All right, because of time. So your response should be that the expected net present value calculated in A and B above will not be the same because different methods are used. In A above, the expected value method produced expected NPV of 38,409, while in B, the simulation method produced expected NPV of 32,000 naira, 32,100 naira. So if you want to add, you can then say it should be noted that the expected value calculated in B will not produce optimal solution because not all cash flows are well represented. You can see that when we were simulating, we are just picking numbers randomly based on the set number. All right. Even you can see we have cash flow of 60,000, revenue of 60,000. We ignore it, right? So you are picking numbers randomly, and that's why you cannot have optimal solution if you are using simulation method to determine the expected NPV. All right. Okay. Let me know if you have any question on this. If not, let's solve the last scope, which is a decision tree. I will not talk too much on this one because of time. The network has really frustrated me today. So let's talk about decision tree briefly. So decision tree is one of the methods of mitigating risk and uncertainty. All right. So what do you mean by decision tree? This involves a graphical or diagrammatical representation of various courses of action involving complex business or investing decision. Generally, businesses engage. I don't want to talk. Let me just add it. Generally, businesses engage in merger and acquisition, divestments, make or buy, make or buy, MBO, let me just leave it at that, make or buy. This kind of business decisions requires a meticulous and careful consideration or let me put it, a meticulous, okay, when carrying out the evaluation of the alternative course of action. Now, what we are seeing here is that, in risk and uncertainty, expected value method, simulation method, as well as a decision tree also makes use of expected net present value, right? So if you're asked to calculate expected net present value, you need to ask yourself, which method are you going to use? The method you are going to use to estimate your expected NPV will depend on the information available in the question. If you are to use expected value method, of course, only probability and cash flow will be given to you. If you are to use simulation method, you are going to be given probability and cash flow. You will also be given random or tag number. So what makes simulation to be unique is when you are given random numbers. If you can see, you can cite random number in a question, it means that you are going to calculate expected NPV using the simulation method. However, for decision tree, the scenario will not be straightforward, right? Decision tree will be used if the scenario is complex, kind of, when you see the scenario, you will know that, no, you cannot use expected value for this, because your probability and cash flow will not be together. The way the examiner is going to coin the scenario, you will know that this one you cannot use probability. If you can, once you see the question, you can't see anything like random number. You should know that this is not simulation. Simulation is out of it. So examiner will tell you that you want to make a final decision, but before you make the final decision, you have to take some steps. There are some steps you need to take before you get to the final destination. All right. Or you have multiple decisions to be made. All right. You have multiple decisions to make before the final decision. So when you have such a scenario in a question, there is no better method to use for the analysis other than the decision tree. So when you are analyzing alternatives using decision tree, there are some procedures you are supposed to carry out. Step 1, steps involved in decision tree. I just hope I'll be able to complete this today. Step 1, construct a payoff table. Construct a payoff matrix table. The payoff matrix table have horizontal and vertical axes. On the horizontal axis is where you have the decision variable, that is the alternatives. Then on the vertical axis is where you have the state of nature. The state of nature is the event in the economy. We've done this in the past. Then step 2. Step 2 is to construct a tree diagram. Draw a tree diagram using the nodes below. Basically, there are 2 nodes when you are constructing your tree diagram. We have the decision node. When you are constructing your tree diagram, everything starts with the decision node and it will end with the decision node. The origin is the decision node. So the directional arrow that will follow your decision node will depend on the alternative courses of action available. If you want to make a choice between 2 different alternatives, then you are going to have 2 directional arrows like this. But if you have only one, then you are going to have only one line in between. If it's only one course of action, maybe you have a project, so it will be only one line in the middle. That's all. So this is called decision node. Now, this decision node, you are going to have your starting point is where you have your decision node. In between your diagram, anywhere you want to make a choice between alternatives, between different alternatives, you also need to draw a decision node. It doesn't mean that it's only at the starting point you are going to have the decision. Anywhere in your diagram that you need to make a choice between different alternatives, you have to draw the decision node. Whatever the choice you have made, then we enter inside the decision node. The second node is the chance node. This is the chance node. Again, the chance node is also known as event node. Event or chance node. This is where you have the state of nature. The directional arrow will depend on the number of states of nature. All right? Let's say if you have 3 states of nature, high, medium, low, then you are going to have 3 directional arrow. If you have 2 states of nature, you put 2 there. All right? So immediately after the decision node, the chance node will follow. All right? The chance node will follow. So these are the 2 nodes to draw your tree diagram. Then step 3, you then label each node. Before that, you assign probability. Assign payoff value and probability. Probability to each node. Okay? Then step 4, label each node alphabetically or numerically. Okay, you can use A, B, C, D, E, whatever, or you use 1, 2, 3. Then step 5, determine expected value or expected NPV. Because of time, let's stop at 6. Then step 6, advice on the alternative course of action to be to take or to be selected. All right, so this is it. This is decision tree. This is decision tree. Like I said, decision tree should be used if the scenario in the question is complex. You only use a complex scenario. You only use decision tree for a complex scenario. You will see it in the question if the scenario is not direct. Ordinarily, when you are given cash flow and probability, that one is very straightforward. Just multiply probability with cash flow, you get your expected value. If in the question you can see a random number, you should know that this one is simulation method. Other than that, it has to be decision tree. All right. So that is that. Let me stop sharing this and move to the learning materials so that we can conclude risk and uncertainty. Let's have illustration. Okay. Because of time, let's solve this illustration number 7. I would have loved to solve this number 8, but that one will take my time. Let me see what I can do about that one. Possibly I will solve it, do video, then we share. But let's solve this number 7. It will be faster. We don't have much time left. Yes, who is helping us to read it? Who is helping us? Okay, let me read
Let me
myself.
read, sir. Okay.
Oh, okay, go ahead.
Tintin PLC is considering a project involving the outlay of 300,000 naira, which it estimates will generate cash flows over its 2 years life at the probabilities shown in the following table. You have cash flows for the project, you have year 1, year 2. Note, all cash flows should be treated as being received at the end of the year. The company's investment criterion for this type of project is 10% required. What is the expected value of the project NPV, and what is the probability that the NPV will be negative?
Yeah, thank you very much. Yes, when you look at this question, you will see that in year 1, we have year 1 and year 2. And in year 1 is very straightforward, right? Of course, examiner is asking us in the requirement to calculate expected NPV. I then need to ask myself, which method am I going to use to calculate the NPV? Am I using the expected value method, simulation method, or decision tree? In this question, I can't see anything like random number. Therefore, I cannot use simulation. So I have 2 options left. Either I use expected value method or I use decision tree. When you look at year 1 cash flow, this is very straightforward. I'm given cash flow, I'm also given probability. I can determine my expected value straight. But when you get to year 2, it's not that straightforward because year 2 cash flow is dependent on year 1 cash flow. So examiner is telling you here that in year 2, you are told that if cash flow in year 1 is 100,000, there is a probability of 0.25 that cash flow in year 2 will be nil. You can see that we cannot use expected value method to do this. Therefore, you have to represent this scenario in a tree diagram. You then determine your NPV, Then you determine your expected NPV. That's all you need to do. Let's do it together. I will stop sharing this and then move to the working note. Solution. So illustration 7. I think that's page 66. Let me see. 65. The name of the company is Tintintin. Is it a PLC or a limited? PLC. So without wasting, please pay attention to what I'm about to say. If on the day of your exam, you have question on decision tree that you want to solve, please, before you put your pen to paper, you have to, it is advisable that you draw a rough sketch of your tree diagram at the back of your answer booklet. Don't draw anything on your question paper because you may be penalized. So go to the back of your go to the back of your answer booklet. Go and draw a kind of a prototype, how you want your tree diagram to look like. All right? Go and draw it at the back of your answer booklet. Once you are satisfied with your drawing, then you can move everything to the main page of your answer booklet. You then cancel the rough sketch you have done at the back of your answer booklet. Why am I saying this? No matter how good you are in drawing, you can never have a perfect drawing at the first instance. You are going to make mistake. And if you have so much mistake, your answer booklet will look rough and you want to avoid that. And that's why it is advisable to always have a rough sketch at the back of your answer booklet. So to draw your tree diagram, you are starting from the left. Okay, you have to make it very bold. All right, so I can come here. I don't know the extent of my table, so you come down a little bit. You can start from the middle of your answer booklet so that you are not boxed in a corner. All right, so I will come here, draw my tree diagram. Like I said, make it very bold. I don't have time to be dressing it. I would have, let me do, okay. Now, in the question, like I said, your directional arrow for immediately after your decision node will depend on the alternative courses of action available. Here, we only have one course of action, which is to invest on a project. So I will just draw one line. That's too long for me. So this would be in year 0. This is year 0. Let me try this one first. Year 0, and then we want to invest 300,000. So I've represented year 0 in the tree diagram. Immediately after the decision node, you have to draw the chance node. All right. Then I will then go back to the question. I've represented year 0 cash flow. I need to represent year 1 cash flow. According to the question, we are given 3 different probabilities. It means that we have 3 states of nature. Remember, probability is always attached to state of nature. So since we have 3 different probabilities, it means that we have 3 different states of nature. And therefore, I would then come here. I would indicate the first probability, the second one. All right. I hope this will be sufficient for me because the way I'm drawing this directional arrow. All right. So I will then go back again. In year one, probability of 0.25. We have probability of 0.25, probability of 0.5, probability of 0.25. Then cash flow of year one is 100, 200, 300, 100,000, 200,000, then 300,000. Okay. Again, I've represented year one cash flow in the tree diagram. Immediately after year one, I need to draw a chance node to close year one. You can see, even despite the fact that I'm not under exam pressure, I'm making mistake, I have to redraw. So that's what I was trying to tell you the other time. No matter how good you are, you cannot have a perfect drawing at the first instance. So I need to close this with a chance node. All right. Okay. So I've represented year one cash flow. My arrow should not enter inside the zero, inside the circle. I hate solving question on decision tree. It's always very stressful, particularly for online. Okay, then of course we need to represent year two cash flow now. In year two is where we have issue. You are told in year two that if cash flow in year one is 100,000, there's a probability of 0.25 that cash flow in year two will be nil. So let's go and represent that. Year two. Cash flow of year one is 100,000. So we are told that there's a probability of 0.25 that cash flow in year two will be equal to nil. So here will be nil. This is year two. Okay. If cash flow in year one is 100,000, there's a probability of 0.50 that cash flow in year two will be 100,000. Here will be 100,000. If cash flow in year one is 100,000, there's a probability of 0.25 that cash flow in year two will be equal to 200,000. So we have represented year two of under year one cash flow. Next, if cash flow in year one is 200,000, there is a probability of 0.25 that cash flow in year two will be 100. So here is cash flow of 200,000 for year one. You can see now, I'm getting close up. Here is, I will manage it. It's becoming tighter. So 0.25. That cash flow, let me shoot it down a little bit so that I will have space there. That cash flow in year two will be 100,000. Okay. Cash flow in year one is 200,000. Probability of 0.5. That cash flow in year two will be 200,000. Then probability, if cash flow in year one is 200,000, probability of 0.25, that cash flow in year two will be 300,000. I've represented that. Then, if cash flow in year one is 300,000, I can push this one down so that I can have space. Okay. See the way that I'm struggling for space? So that's why it's always advisable to draw a rough sketch before you move to the main page. Otherwise, your book will look rough. So if cash flow in year one is 300,000 naira, there is a probability of 0.25 that cash flow in year two will be 200,000. So here will be 200,000. Cash flow in year one is 300,000. Probability of 0.5 that cash flow in year two will be 300,000. If cash flow in year one is 300,000, there is a probability of 0.25 that cash flow in year two will be 350,000. Let me redraw this one. $350,000. So we've also represented year two cash flow. At this point, we need to close our diagram with a chance node. Okay. Let me redraw this one. All of you are just enjoying now. You are the one that's supposed to be going through all this stress. I wish I'm in a physical class. What concerns me with all this stress? You are the, you have shifted all the burden on lecturers online. Lecturer are the one that will be doing the stress. Just sit down there and it is well though. We can't complain. It's our passion. See the way I'm drawing and redrawing, because the diagram does not align, so I have to make adjustments. This is the kind of thing you are going to experience on the day of your exam. That's why it's always good to make a rough sketch. And the last one. Fantastic. Yes, so this is our drawing. Now that we have a complete diagram, the next thing we need to do now is to determine NPV, because in the question, the examiner has given us cost of capital, so which means that we are going to calculate NPV. But if you are not given cost of capital in the question, you only calculate expected value. So since we have cost of capital, we calculate NPV straight. Therefore, let's calculate NPV for each node. This is the most stressful part of it, calculating NPV for all these plenty nodes. So next is that you need to label your node alphabetically or numerically. It's your choice. So let's use alphabetic. A, B, C, D, E, F, G, H, I, J, K, L, M, and N. So we are going to calculate NPV for all the nodes. So without wasting time, let's start. I'm not coming back to this question next week, so I have to finish it. Wherever we finish today, that's it. So we need to calculate NPV for node A. So node A, create a column for year, cash flow, discount factor at 10%. I have to be faster than present value. Year 0, 1, and 2. Cash flow in year 0 is 300,000. I will then go to node A. Here is node A. Trace node A to year 1. Cash flow in year 1 is 100,000. So here will be 100,000. Cash flow in year 2 for node A is 0. Therefore, here is 1. Here is 0.909, 0.826. Multiply. This will give us 300,000 negative. Here will give us 9,900. Here will give us 0. Then our NPV. What's our NPV, please? Are you still with me, or I'm on my own?
We are with you, sir.
So what's my NPV? That's
100.
negative. So I will then go to node B. Oh, I don't have space again. Let me create additional nodes. Let me try. This one will be sufficient. So node B. For node B, from our diagram, cash flow in year 1 is 100,000. Cash flow in year 2 is 100,000. Create a column for year 0, 1, 2. Cash flow 300,000, 100,000, 100,000. Discount factor at 10%, 1.909826. Present value 300,000.
9,900.
900,
82,600.
600. What's our NPV? Node C. Yeah.
126,500.
126,500 negative. Node C. Cash flow. Discount factor at 10%. Then present value. Year 0. 300,000.
100 and 200.
300,000. So from the diagram, node C, 100 and 200,000. Year 1, 100,000. Year 2, 200,000. 0.909,
Okay.
0.826, 90,900. What do you have? 200,000 multiplied by
165,200.
165,200. Final answer.
43,900.
43,900. Negative. Then node D. Yeah. Cash flow. Discount factor at 10%. Present value. Year 1 to 2. 300,000 initial outlay. Then for node D, cash flow in year 1 is 200. Cash flow in year 2 is 200. Sorry, it's 100,000.
100.
So 200, 100. Multiply by 1.909.826. 300,000. Here is 82,600.
181,800.
800. Final answer. Node E.
35,600.
35,600 negative. So node E. 1, 2, 3, 4. 1, 2, 3, 4, 5. So this one will not accommodate. Node E.
300. 200. 700.
Yeah, 0, 1, 2, 2. 300,000. Then in node E, from the diagram, year 1 is 200 cash flow. Year 2 is also 200. So 200,000. 200,000. 1.909.826. 300,000. 181,800.
165, 200.
181, 165, 200. Financer.
47,000.
47,000 positive. Then we have node F. The journey is still far. Yeah. Cash flow. Discount factor at 10%. Present value. Year 1 to 2. 300,000. Then node F. From the diagram, cash flow in year 1 is 200. Cash flow in year 2 is 300. 2, 3. 300 multiplied by 1.909826. 300,000. 181, 800. Then 0.826 multiplied by 300. What do you have?
247,800.
247,800. Final answer. Node G.
129. 129,600. Is this correct?
129,600.
Yes.
Okay. So node G. Create a column for year, cash flow, discount factor at 10, then present value. Year 1 to 2. 300. For node G, from the diagram, year 1 cash flow is it G or F? Have I done F? I think I've
Yes,
done,
we've done
yes,
F.
I've done
We've
F.
done F.
Okay, we're almost there.
300
So,
and 200.
node G, that's 300 and 200. 300, 200. 0.909826. 300. Here is 165. What do you have? PV of year 1.
Yeah, 1K.
What's
27 to
yours PV of
700.
year 1?
27 to 700.
272. Final answer.
137,900.
137,900. We are moving to node H. So cash flow, discount factor, 10%, present value, 300,000. Node H from the diagram. Year 1 is 300,000. Year 2 is 300,000. We are getting there. 300, 300. Here is 1.909826. So let's multiply. I think yes, 272, 700. 300 multiplied by, I
247.
think we have
No, not
247,
800.
247, 800. Final answer.
220, 500. Yes, it can't be correct.
220, 500. Then node I. node I, create a column for year, cash flow, discount factor at 10%, then present value. Year 1 to 2, here will be 300,000. Year 1 cash flow is 300,000 in node I. Year 2 cash flow in node I is 350,000. Here is 1.909, 0.826, 300,000. So that's 272, 700. 272, is it 700? Yeah, 272, 700. Then 350, what do you have?
289, 100.
289, 100. MPV,
261, 800.
261, 800. Okay. So the next one is node L. We have node JKL. Now, when you look at our diagram, okay, when you look at our diagram, you will notice that node J is coming from node ABC. Node J is coming from node ABC. Therefore, you need to combine the NPV of node A, B, and C. All right, combine NPV of node A, B, and C. So for node J, we have 5 more nodes to go. So node J, combine the NPV of node A, B, and C. So you then come here, node A, B, and C, working NPV. So in node A, we had a negative NPV of, is it 209, 100? Yes, 209, 100. Here is 209, 100. Multiply by the probability of node A. Let's go back to our graph. So for node A, NPV of node A is 209, 100. So with a probability of 0.25 as it's coming to node J. So multiply by probability of 0.25. Multiply by 0.25. This is negative. Then what's the NPV of a node B?
126, 500.
126, 500, negative, with a probability of 0.5. Then NPV of node C.
43, 900.
43,900, negative. Multiply by a probability of 0.25. So let's multiply. Two nine
52,
100 multiplied by
52, 275.
275, negative.
63, 250.
63,250.
10,975.
975. Let's add it up. That's 1, 6, 7, 1, 2 something.
126,500.
500. Thank you. Negative. So that is note J. We then move to, I've exhausted this one too. Oh, wow. How many pages are we going to use tonight? I need additional pages. I need more sheet of paper. I need more sheet of paper to finish the exam. Okay. I think we can have more than 2 pages. That's okay. So we're moving to note K now. Note K. Again, combine the NPVs of node K. From the diagram, node K is coming from node DEF. D, E, and F. So create a column for node D, E, F. Then we have a working for the NPV. It's not difficult. The only thing is just that it takes time to solve. In fact, on the day of the exam, I will not advise if you meet this kind of a question, I won't advise that you make it your first attempt because it can throw you off balance. It will waste your time. All right. But if you have solved you have pocketed like 1, 2, 3, or even 4 questions, then you can balance on question like this. All right. So node K.
35,600.
35,600 is the NPV.
Negative. Yeah.
35,600 negative. Multiply by probability of 0.25. Then what's NPV of
8,000.
node E? Pardon?
It's 47,000.
47,000 positive. Multiply by 0.5. Next one.
129,600.
129,600. Multiply by 0.25.
89.
Multiply from
The first one, 8,900.
8,900 negative. Then this one will be
23,500.
23,500.
32,400.
32,400. Final answer.
$47,000.
47,000 positive. Then we are moving to node
L.
L. Node L is coming from node
GHI.
GHI. So combine the NPVs of node G, H, and I. Node G, H, I. Column for working, then NPV. So for node G, what's our NPV?
137,900.
137,900 multiplied by 0.25. Next one.
220,500.
220,500 multiplied by 0.5.
261,800.
261,800 multiplied by 0.25. There is 110, 250. 30 what?
34,475.
475.
65,450.
65,450. Add it up.
210,175.
210,175. So we have, go back to our diagram. The next one is node M. Node M is coming from node J, K, and L. So you combine the expected value of node J, K, and L with their probability. Node M. Combine.
126,500.
I'm coming. The MPV of node J, K, and L. Node J, K, L. Working MPV. So give it to me. What do you say is the expected value for J?
126,500.
126,500
Negative.
multiplied by 0.25 negative. Then K.
47,000.
47,000 multiplied by 0.50. Node L.
210,175.
175 multiplied by 0.25.
31,625.
31,625 negative.
23,500.
23,500.
52,544.
52,544. Final answer.
44,419.
44,419. All right. That's it. We have about 2 minutes more to go. So that's node N. After node N is after node M is node N. So node N is coming from node M. Therefore, whatever you have as your answer for node M is what you are going to give to node N. So this one will then be 44,419. That's our final answer. That's our final answer.
Is it like you should? Oh, need a pen.
This is node N. Node N is equal to node M, which is equal to 44,419. We then say the expected net present value is 44,419. Without wasting more time, number B, Wow. Number B, we are to calculate the probability that the NPV will be negative. Probability. So the probability that the NPV will be negative is the probability of the nodes with a negative NPV. This is shown in the calculation below. Let me write this. All right. So when you look at our first four probability that we calculated, you will notice that for probability, the NPV we calculated for node A, B, C, and D. Node A produced negative NPV. Node B produced negative NPV. Node C produced negative NPV. And node D produced negative NPV. After that, we start having positive NPVs. Therefore, the probability that the NPV will be negative will represent the probability of the nodes with a negative NPV. From our diagram, for node A, B, C, and D produce negative NPV. So to answer this, you are going to pick the probability of node A in year 1. You multiply with probability of node A in year 2. Probability of node B in year 1 multiplied by probability of node B in year 2. That's how you are going to do for the four of them, that is the A, B, C, and D. So let's quickly do that so that I can release you. You have tried. So I will then come here, node, working, then probability. We have node A, B, C, and D. Probability of node A in year 1 is 0.25. Probability of node A in year 2 is 0.25. Probability of node B in year 1 is 0.25. Is it 0.25 or 0.5? Let me go and check. Node B, probability in year 1 is 0.25. Yeah. Okay, 0.25 multiplied by probability of node B in year 2, 0.5. Node C, year 1 probability is 0.25. Year 2 probability is 0.25. Then node D, year 1 probability is 0.5 multiplied by year 2 probability is 0.25. Let me confirm C and D, just to be sure. Node C in year 1 probability 0.25. Okay. Then node D, 0.5, 0.25. Yeah, you are correct. We then multiply. Tosin, are you still there? Multiply for me, please.
Yes, sir. The first one, 0.0625.
0.0625, 0.125,
Yes.
0.0625, then
Yes.
0.125. Add it up. Add it up. 25 plus 12.5. That's it.
That's
0.375.
0.375.
That's it. So I would then say the probability that the net present value will be negative is 37.5%. That's the end of the question. That's it. Let me know if you have any question for me so that we can close the class. You guys, you have really endured tonight. Thank you for your patience. I really appreciate. Let me see. As expected, some of you have disappeared. That's okay. Yeah. Ahmed is still on. Jeffrey, Ether, Etima. All right. I can see Ife Damola, Ijoma, Laura, Tosin, of course, Sharafaddin. Thank you, every one of you, for waiting behind and for supporting me. I really appreciate. And
Thank you, sir.
sorry once again for taking much of your time. I've extended beyond the closing time. I really appreciate. I will see you next time by the grace of God. Good night, everyone. So
Thank you,
when next
sir.
we are when next we are meeting, we are starting business valuation. That is the Baba and Baba. That is the Oga Patapata of SFM. All right. So let's every one of you join and ensure you join the class in our next the next class, because that's don't worry, when we meet next week by the grace of God, we'll talk more about valuation. All right, good night everyone. Bye-bye.
No, sir. Thank you.
Yeah, bye.